Is it visible?
Yeah, go ahead.
Yeah, so the company I chose is Indian Tobacco Company, which was started way back in 1910, and it is one of the largest cigarette manufacturer in India, and it basically operates in five industries. That cigarette industry is considered as one of the other part of FMCG. So there are two FMCG cigarettes and FMCG others, hotels, paper booths, paper and packaging, and agribusiness. So the revenue, 40 percentage of the revenue for the company ITC comes from selling cigarettes. Rest 26% is come from FMCG and 15 from agribusiness and 20 from paper and packaging. However, the profit, 84 percentage of the profits they come from cigarette business, whereas only 2 percentage comes from FMCG others. Whereas right now they are also trying to broader their market in FMCG. Recently, they bought a yoga bar because there are. That will I'll cover further why they are shifting from cigarettes to FMCG. So this is the PNL, and these are all the ratios. So in this, we can see that the revenue is showing a steady rise, and in financial year 2022, it showed a great revenue. And um, yeah, so now they are shifting their focus to FMCG products because of ban of illegal cigarettes. Now, when the illegal cigarettes are banned, so if you know what are illegal cigarettes, there are those which are imported and there is no tax levied on those cigarettes. So if government tries to seize those cigarettes, people start to move. As we know that cigarette demand is inelastic, so people try to move to the cigarette company which manufacture in India, and ITC is one of the largest producer. So they are so they are shifting their focus to this. But we know that there are tax rates are increasing on cigarettes, so they are also starting to focus on FMCG. And we can also see that our earnings before interest, tax, and amortization is also increasing, and the average profit margin is 60%. The company has also showed consistent positive cash flow. And one thing which I found is that they have very high CFO to EBITDA ratio. That means they are easily able to convert their earnings to the cash flow for the operations. But I also found out that because they have very high earnings, they pay out more dividends to the stakeholders. And even days of working capital, they it shows a decreasing rate, which shows that uh, the company is efficient in making working capital converting working capital to revenues. In this, we can see that the equity is also increasing at increasing rate with debt. So the debt to equity ratio is very minimal. So there is a very few amount of debt for per all equity. And even return on equity and return on capital employed is showing a steady growth. So these are all the findings, and one thing which I could not understand is that they're even able to pay out high dividends, and even they're able to convert their earnings to cash flow from operations. Yeah.
Great, Radhe. Are you done?
Yeah.
Okay. So I would request you to keep the presentation because we'll discuss
Yeah.
around
Sure.
it. So yeah, you can keep it. So Gaurav, shall I go ahead with the first set of comments?
Yes, please.
Yeah, okay. So Radhe, first of all, great presentation here. I mean, I like the way that you converted this into a story and tried to tell a story. That is what I've been telling from day one, that we need to understand the story behind the company. So good attempt. So I have a few observations that I would like to discuss, and Gaurav, pitch in whenever you want to.
Sure.
Uh, so one thing is, if you look at the growth in PAT, okay, I am assuming that all these figures are correct, okay, so I'm not going
Yeah.
into the figures being miscalculated. So the PAT growth and the sales growth, so how do they compare, and what does that tell you?
Um. There is a high rate of tax.
Uh, okay.
There's one slide, Radhe, where you showed the revenue and the profits. Let's go to that slide. And with the
Okay.
same question, I think this will be interesting.
Yeah, so most of the revenue comes from cigarette, and cigarette, like current rate of tax on cigarette is 52 percentage.
Okay.
So that's why profit after tax is
Mhm.
high. But
Uh,
yeah,
so actually, yeah. So maybe that's the right answer,
low.
Radhe.
Sorry.
So yeah,
Yeah.
low. Exactly.
Yeah.
Thanks. Glad you corrected it
Yeah.
because
Yeah.
it
Sorry.
means that you and I are thinking on the same line. So see, generally, when the sales of a company grows at 23% or 8%, the profit generally grows a little faster. Okay,
Yeah.
because can anybody tell why? Like if revenue grows from 100 to 120, generally, so that's a 20% growth of revenue. Generally, profits will grow higher than 20%. Can anybody say why? Both EBITDA and PAT, they generally will grow at a faster rate than revenue growth.
Maybe after certain year, the cost of goods sold starts to decrease.
No, cost of goods sold will not decrease rather because it's you have to purchase raw materials to sell, right?
Yeah.
So there is no logical reason that COGS will decrease. Okay, so anybody? So the reason is fixed costs. Okay. So
Yeah.
fixed costs are costs that don't increase as your number of units sold increase, right? So for example, packaging cost, if you're selling soap, will increase linearly with the increase in volume, right? If volume increases, for each volume extra, you need a packaging cost for it, right? But in terms of your R&D expenditure, or maybe the fixed cost related to running that factory, whether you run in 1 year you produce 1 lakh soaps, or in another year you produce 1 lakh 10,000 soap, maybe a lot of the factory costs will not increase, right? Because the amount of light, power, oil you consume may be the same. There will be some factory costs that will increase. There will be variable costs. So costs are of two types: fixed costs and variable costs. So, because a large percentage of total cost structure of a company is fixed, which does not increase when your sales increase, what happens is if sales increases by X%, profit and EBITDA generally increase by X plus Y%. This phenomenon is called operating leverage. Okay, I just make a note of this point. This is, you will come across it in all con calls. So this is called operating leverage. So I am curious that for ITC that is not working out for 3 year and 5 year periods, right? The sales growth is almost the same. In fact, in 3 year period, sales growth is higher than PAT growth, and also EBITDA growth, right? So not only PAT, so PAT can be explained by tax, Radhe, but EBITDA cannot be explained by tax, higher tax,
Yeah.
right? So this is one question. Can you note down the question, Radhe, and you have to come back with the answer for this.
Yeah. Sure. Just a second.
And at the end of the session, guys, each of you on our group, you post the questions for which you have to come back with answers. Yeah, so that
Okay.
Gaurav and I have a track.
Yeah.
Okay.
Yeah.
Yeah, Gaurav, any questions?
No, no, I think you asked the right question. So when you asked about that revenue and PAT growth, I wanted to, I had the same question
Same
as well.
question. Right,
Because
right,
every,
right.
ITC is a funny company. Yeah.
Exactly. So, Radhe, can you move to the next slide once where you, uh, yeah, so this analysis was, I think, good, that CFO to EBITDA, CFO to PAT, both are good. Now, you said that high dividends, right? You
Yeah.
said this company pays high dividends, but you were not able to understand how it pays high dividends, but it still has high CFO, cash
Yeah.
flow from operations. Yeah.
Yeah.
That is because cash flow from operations does not include, dividends.
Dividends. Yeah.
Yeah, dividends is a cash flow from
From
investment or cash flow from financing.
financing.
Correct. So it CFO does not get impacted whether you pay dividend or you don't pay dividend. Okay. So that is the answer to your question. So this is a question to all four of you. Okay. So ITC pays out ITC pays out 80% of its profits as dividends. Okay. Uh, Whereas there are tech companies which don't pay out dividends. There are some companies which don't give a dividend in spite of making good profits. Okay. So a company which pays out 80% of its profits as dividends to shareholders Can you guys tell me what kind of company this will be? Just based on this one fact, why is it doing that? What kind of companies will do this? Almost pay out all their profits in dividends.
Maybe Nirvan, you can give some options. I think it's
Okay.
or will it make it so easy? Then?
No, no, it won't make it easy, but it'll make it tough for me to come up with options.
Okay, okay. Yeah, yeah, yeah.
And anyway, so let me think.
Because I have two conflicting answer which might fit this question.
Right, right. So
Uh,
if
No,
you
I
have
don't
options, go
exactly
ahead.
have an
no, no.
answer. Hello.
Yeah,
Yeah,
Shantanu.
Shantanu.
Yeah, I mean, I don't exactly have a proper answer, but I mean, they would be obviously paying more dividends so that the investors stay invested in the hope of earning more in the future, right? From the
Okay,
company through dividends.
good answer. We
Yes.
can have a discussion on this. Any other answers before we move to Gaurav?
Let's ask one after the other. I mean, instead of that, Radhe, what
Sure,
do you
sure.
think? Any feedback on Nirvan's question?
So even I think that this
Hmm.
to show that company's financial position is well,
Hmm.
and even it might attract the stakeholders and positive expectation. It provides a positive expectation for future earnings. That's why.
All right. Bhavna.
I am really not sure.
And even they are able to convert. I mean, they're able to receive cash easily and fast. That's why maybe tech companies they don't receive cash on the spot.
Okay.
Right.
Yeah.
Right. Okay. So Bhavna, you don't have any opinion. Okay. Pranav, what do you think?
I think I have more or less the same answer. I think if the company is paying out dividends, then the company is willing to share its profits with its investors. So it's a good thing. Many companies don't do. So yeah, I think it's if they do share profits, it's a good thing for the investors and for the company.
Great. Good. Nirvan, one question. Should we
Yeah.
answer our opinion right now, or do we
No,
do it in a follow-up discussion?
I actually have a counter question, Gaurav, if I may
Okay.
ask
Yeah, yeah. Please,
that
please,
to
please,
their
please,
answer. So
please.
basically, my counter question is then companies that don't pay out dividends at all, are they unfriendly companies to investors? Are those companies not investor friendly?
Google, for example.
Yeah, for example, Google or many companies don't pay dividends. So are
DMart.
they? Yeah,
They are investor friendly, but they use that as retained profit for R&D. Whereas right now there is not much growth in R&D for ITC,
you are
and
almost
Yes.
you've hit the nail on the head. Great answer. Great answer. Continue, continue.
yeah. So the article which I read in that they had mentioned the same thing that ITC is having large amount of cash inflows, and right now they are not using it to expand or diversify, and so they are paying out as dividend. Whereas some
Right.
companies they take in as retained profit and used to expand.
Exactly. So that's exactly the right answer. Only one correction. It's not only for R&D expenses. See, those companies. So when you make a profit, okay. Acha, when you're not speaking, Radhe, just put on mute so that there's no echo, etc.
Yeah.
What happens is when you make a profit, there are two things that you can do as a company. Either you can pay it out as dividends, or you can retain that profit and invest it in the business, either in the same business, like if you're in the FMCG business, in the same business, or you can start a new business with it, right? For example, Tata Motors or Reliance was in oil and gas, and it decided to get into telecom, right? So that is the two uses of profit. Yeah. So the fact that ITC pays out almost all its profits, and the fact that most of its revenues and profits come from the cigarette industry. So is cigarette consumption going up in the world or going down in the world, or is it staying constant? Guys,
Increasing. It's
okay,
increasing.
okay. So it is, I don't know the exact figures, but I think it may be increasing because population is increasing, but overall consumption trends are down. Yeah. So cigarettes are no longer cool as they used to be at one point of time. So when you have a business where the business is, it's called a cash cow business, which means that the business generates a lot of cash, but it does not have high growth prospects, right? So cigarettes business is a cash cow business. It doesn't require money for growth because they are not producing too many extra cigarettes. At the same time, they generate great cash flows because people who smoke, they are, as Radhe used a technical term, inelastic. They are price inelastic. So it means that even if you increase the price one cigarette from 17 to 25 rupees, the person who is addicted will keep buying them, right? So exactly the reason why ITC pays out a lot of cash, because it doesn't have a lot of exciting areas to grow in, right? So it says better return it rather than keep it in my balance sheet and not use it anyway. Yeah, Gaurav, anything else before we move on?
No, no, uh, no, nothing from my side. Yeah.
Great. So good observations, Radhe. I think you also said that working capital was coming down. That was a right, absolutely correct observation. There were also a few more tables, right, which you didn't probably look at. Is it? This one. Can you just expand it? Yeah. Okay. So what is happening here? What did you say here? That okay, ROEs are more or less stable. Uh, ROCs have decreased a little. Okay. So, one aspect that I would request you guys to pay attention to, and we had discussed this, what was the formula for calculating ROE? There was a formula that I had spoken about. There was a name to that formula.
DuPont formula.
Absolutely.
DuPont ROE.
So, yeah. So, the three elements of DuPont are mentioned here in the table, right? What are the three elements? Bhavna, can you give an answer?
Yeah, asset turnover ratio, uh, the net profit,
Mm-hmm.
and financial leverage.
Absolutely, that's the correct answer. So, a company which is delivering very high ROEs due to financial leverage, okay, and it has low net profits, and the next fixed asset turnover ratio is also not so good. So, how would you evaluate that company's ROE, Bhavna?
Can you please repeat the question?
So, I'm saying that ROE is a multiplication of three terms, right?
Yeah.
So, imagine a company has good ROE, high ROE,
Okay.
but most of the ROE is not coming because of the net profit percentage or the fixed asset turnover ratio. It's coming because of a high financial leverage ratio. So, if this is the case, then is that good quality ROE, medium quality ROE, poor quality ROE?
No, I think it's a bad quality. Only if it increases because of the other two, it is a good quality.
Okay, good answer. So, more or less, I agree with you. Financial leverage means that you are probably having adding more debt, right, to your balance sheet, and that is giving you a kick in the ROE, right? Whereas a net profit increasing or fixed asset turnover increasing, they are actually operational efficiency improvements, right? So, you're not simply adding debt to your balance sheet to improve your ROE, they are more sustainable, and the market will also value them more, right? Which is why it's important to not only look at ROE, but to look at all the three components of DuPont. Radhe, Bhavna, is that clear?
Yes.
So, Radhe, when you next time when you present and when you're talking about ROE, please get into each of the three DuPont parameters as well. Yeah, you're on.
Yes.
Yeah, cool. Okay, so I think we can move on to the next person, Gaurav, if you're okay.
Yeah, yeah, yes.
Sure. Yeah, who's next? I think Pranav, right?
Yeah, I have not made the PPT. I have just explained it through Excel. Is
No
it all
problem.
right?
Yeah, PPT was not a requirement as long as you can get the message across. We are happy to. It's about the quality of your analysis, not really about presentation at this point of time. But I really appreciate rather your effort to make the presentation. It definitely makes it easy to convey the story.
Thank you.
Yeah. So the company which I'm. Can you see my screen?
Yeah.
Yeah, so the company which I'm going to talk about today is Rainbow Hospitals or Rainbow Children's Care Limited. So the company is a leading multi-specialty. It specialization is specialize it specializes in pediatric obstetrics and gynecology hospitals. It has 14 hospitals all over India, uh, and total it has total bed capacity of 1500 beds, out of which around 1100 beds are operating beds. So the company, in terms of public listing, the company is new. They gave their IPO around May 2022. So they are newly listed on NSE and BSE. So that's the basic background of the company. Talking about revenue, the revenue streams are their revenue streams are stable, but during COVID, their business was affected, which we can see during FY21. Their revenue decreased from 719 crores to 650 crores. The reason was that the main reason was COVID, because during COVID, most of the hospitals were occupied for the facilitations of COVID patients and facilitation of COVID patients. And during their concourse, they also said that many patients. So when it comes to surgeries, there are some surgeries which are elective, which you can postpone. So many patients postpone their surgery during COVID situation. So they got their business was affected during COVID, but now they are gradually becoming more stable. They are coming out of the COVID situation. So their revenue is now they are again increasing again. About the EBITDA, it's the same thing. The EBITDA was increasing during FY19 and FY20, but it decreased during FY21. And then again, it starts going up to 308 crores during FY 2022. I think more or less their EBITDA and PAT, EBITDA percentage and PAT percentage, it was more or less it was affected by COVID situation. The revenue streams got really limited during COVID, so it was one of the negative thing. Matlab, it was one of the things that they couldn't get out of. It was like it was necessary for them to get COVID patient to get COVID. Uh, I mean, what I mean is that their hospital is a gynecology hospital, so business was affected because of COVID. They didn't. I don't think they treated COVID patients, but because of COVID, their business was affected. Uh, Moving on to the balance sheet, debt. So the companies now planning to do some greenfield and brownfield expansions. So they have raised some debt. They have raised some debt during FY21 and FY22 for their expansions. They are based from Hyderabad, Bangalore, and Chennai, and they also have hospitals in Delhi. But they are trying to expand their hospitals in Delhi and some in Northeast. So they have raised some debt on that. Uh, Financial leverage ratio. So ROE is more. It's ROE and ROE is a good. We can see that ROE is also increasing during FY19 and FY20. It decreased during FY21, and then again it's increasing during in FY 2022. So we can if we talk about ROE, so financial leverage ratio is around 2.19% in FY22. Net fixed asset turnover ratio is 1.1, and asset turnover ratio is 0.75. So what we just talk about, financial leverage ratio is 2.19. So maybe we can say that they are because of they are raising debt. So maybe because of that, the ROE is increasing. but not because of net fixed asset turnover ratio and turnover and asset turnover ratio. And ROC has also the same pattern. It increased during FY19 and 20, and then it decreased, and again it got stable. Uh, but talking about cash flow operations, their cash flow has always been in a positive. The net cash flow has always been in a positive. Uh, and also their days of working capital is in negative, which is a good thing about the company. It means working capital days are in negative, which means that it's a good thing. It generally means that they are getting the cash from their customers before they have to pay to their suppliers. The working capital days in the FY 2022 was -7, so they are getting their money back from their customers 7 days before they have to pay to their customers. Uh,
Pranav, sorry to
and
interrupt, but uh, in what you're showing us, the days of working capital are positive and increasing in the Excel sheet.
Oh yes. I
Yeah, actually, I
guess
mean, I
the
actually
thing
opened
is,
Screener to
I
check this as well. It is what Pranav is saying, but over here I think there is some
Yeah,
mistake.
Yeah, so yeah, actually, even I had this issue, so I was going to ask while I present because my days of working capital too was very different from the one on screener. While
okay,
actually the formula is correct, it's working capital into 365 by the revenue.
correct.
So I don't know why is there so much of a difference.
Okay, so
That's
we can check that after
yeah.
the
Yeah.
session is finished. Pranav, how did you fill up this working? Can you go to one of the cells just so that, or is it? It's probably a hard coded thing, is it? Okay, balance sheet.
yeah, I think it
Yeah, you
was
can go to the balance sheet, you'll find the
Yeah, yeah.
working capital.
Go to the balance sheet K16 and G2. We'll see. Go to the sheet titled balance sheet.
K16
No,
is
no,
here,
no.
I
No,
Balance.
guess.
You
no.
need to go to the sheet.
You
Yeah,
go to
Bottom.
go
there's
to
a
the
sheet नीचे बैलेंस शीट वाला.
क्वार्टर के पास लिखा हुआ है. नीचे की तरफ शीट्स होता है ना, की मेट्रिक प्रॉफिट एंड
Yeah,
लॉस लिखा हुआ है वहाँ पे. करेक्ट.
यहाँ पे K16
yeah,
क्या
yeah.
है?
Working capital.
K16. Working capital is 286.47.
अच्छा, वर्किंग कैपिटल बोल के डायरेक्ट एंट्री दिया हुआ है क्या इस पे
हाँ, that's
बैलेंस शीट?
why.
अच्छा, ओके. ओके, डिवाइडेड बाय रेवेन्यू, एंड वो रेवेन्यू का सेल करेक्ट पकड़ा था ना प्रणव फॉर्मूला
हाँ.
में? ओके, ओके. ठीक है. We'll take. I'll take a look at this and we'll discuss later. Okay. So where were you reading these numbers from? From screener, is it? The 7 days negative, जैसे आप बोल रहे थे प्रणव?
Yeah, so yeah, 7 days is yeah, 7 days -7 is on screener.
Okay,
Yeah,
okay,
I actually didn't realize that it was 107. Yeah.
okay. ठीक है. Okay. We'll look into that. You can proceed.
So yeah, so continuing, so they in terms of in term yeah, so in terms of cash conversion cycle, it is also -78. Uh, it's on screener. So in terms of cash flow and generating cash from the revenue, they are really good at doing that. Maybe because of the business. So in hospitals, most of their customers pay from insurance. So insurance companies pay to the hospitals. Some of the breakup was the customers pay in cash, and small amount was of institutional payers, which is I guess government institutions and government schemes that they provide to their customers through government. Yeah, so maybe because of that reason, their working capital is good. Working capital days is in negative. Uh,
I'll just interrupt Pranav. You have to
Dividend
speed up.
payout ratio.
Pranav, just a second. Please speed up a little bit because we have like for 30 minutes and there are two more people who will present. Right? You can speed up. Yeah.
Yeah, yeah.
Yes.
Yeah. So yeah, in terms of dividend payout ratio also, they have paid dividend to their investors from time to time. Uh, I'm not sure about how much they gave or how many times they gave, but they have given amount of their profits to the investors. Promoter hold In terms of promoter holding, there were some fluctuations. It has somewhat decreased, uh, and they have sold some of their equity to the major investors, which is the CDC Capital. It's a British investing company. So they have sold some of their shares to them. Uh, P ratio, price to equity ratio, it's current 26, which I think it's a good, more or less a good value. EV and yeah, so PB, I'm not sure what PB ratios. I can't remember.
Price to book.
So yeah, that's it. Price to book value, which is 2.6. So I think it's a good number. And overall, talking about Rainbow Hospitals, there are some negative sides to it, but more or less they are, in terms of efficiency, they're doing a great job. There are some negative points regarding Rainbow Hospitals, but overall it's a good company. It's a good company. Yeah, that's it.
Pranav, don't leave us at negative points. Tell us the negative points.
Yes, exactly.
Yeah.
Yeah.
Could you expand it a bit further? What
So
are the negative
I
points?
guess, so when I was doing forensics of Rainbow Hospitals, one of the major negative point that I found was when I was doing related party transfer. So when I calculated their overall related party transfer, it was a major chunk of their whole revenue. So most of the revenue is coming from their subsidiaries, or we can say related party transfer. So I think it's a red flag, like how, like, they are not generating, they are most of the revenue, if they are coming it is if it is coming from related party transfer, then it's a red flag. I was not expecting that it
Okay,
is the case,
Pranav,
but I
I'll
calculated
stop you
like
here.
two to three times.
I'll stop you here. So the homework for you is to read up on related party transactions and to come back and tell us, after reading on related party transactions, whether this is actually a red flag or not for Rainbow. Okay. So just in your
Yeah,
today
yeah.
in the note that you sent to Gaurav and me, just write that you think related party transactions are an issue because of high subsidiary related party transactions, etc. Your task is to go back, read up about RPT, then to come back and give us a fresh view whether it is a problem or not. Understood?
Yeah, yeah,
Okay.
yeah.
Gaurav, go ahead.
No, no, I think good question actually. This one.
Yeah, I
Um,
have one or
I,
two
ju-
more. Gaurav, I
I just
think
have a feedback. I just have a feedback
yeah,
for you,
go ahead.
Pranav. Your analysis is very good. You actually went very deep into this topic, and you are trying to find out key questions, and these are good things that you are figuring out that even related party transactions could also be a problem and all in the forensics. One thing that you really need to do is time yourself so that you can finish up the presentation, say in 10 minutes, very fast, whatever sharp points you want to give, and then maybe jump onto the questions and all of those things. Yeah. So one way that I
Yeah.
practice doing that is kind of rehearsing that once or twice, just to time myself. Okay. Yeah.
Great.
Yeah,
So
okay, yeah. Thank you.
Gaurav, I will take some more time because I
Yeah.
think
Please
it's
take, please take.
important. Guys, please don't stop sharing your sheet as soon as you finish speaking because we will give feedback on the basis of your sheet. So, Pranav, can I request you to again share your screen?
Yeah, yeah. 1 second. Yeah.
Yeah.
You can see it, right?
Yeah. So, this is exactly the right screen. So, you said ROE. What were your comments about ROE? You said that most of the ROE is coming from the financial leverage ratio, and therefore, because they are taking more debt for increase in greenfield, brownfield, etc. So, you didn't say it, but I could sense that your view was quality of ROE was not so high, right?
Yeah, yeah.
Yeah. So can you take a look again to all the three DuPont, components and actually uh, tell us again that whether that is a problem or what is the trend? For example, you said financial leverage ratio is high at 2.19, but what is the trend of the financial leverage ratio over the last 4 years?
Yeah, it's decreasing.
It's decreasing, right? So that is good or bad?
It's a good thing.
Correct. Next, net fixed asset turnover ratio. How's the trend?
It's increasing
Good or bad?
from 0.8 to 1.1.
Good or bad?
It's a good thing.
Okay. And
It's a good thing. It's a good parameter.
right. So sorry, not net fixed asset turnover because that does not directly come in the formula, but asset turnover ratio. But your answer is the same because asset turnover ratio is also increasing. What about PAT? Check the FY22 PAT
PAT has
versus
also,
yeah, increased, right?
yeah, it's also increasing.
So
Yeah,
all the three parameters in ROE they have drastically
yeah,
improved, right? So you were quick to analyze and just
yes,
look at the last year's number and just you gave a very impulsive answer, but you should look at the trend because एक company जिस level पे आज थी अगर उससे if it is improving from that level only then the stock price moves. Okay. If there is a great company which was doing brilliant DuPont numbers, but tomorrow it decreases a little bit, then the stock price actually goes down, right? So companies which are improving is what we are looking for. So in this case, actually, they are slam dunking the ROE. They are going really well on that. So just that bit you need to pay attention to. Yeah. Thanks. Good presentation, Pranav.
Yes, good presentation, Pranav.
yeah. Thank you.
Shantanu ji.
Yeah. Is my screen visible?
Yeah.
Not clear.
Yeah. Visible.
Okay. So the company I chose was RVNL, Rail Vikas Nigam. It is a central public sector enterprise, and basically they are into infrastructure, engineering, construction for the railway. So they do, all this doubling, gauge conversion, and electrification works, and then bridges. They construct those cable bridges, etc. And so they basically are something what you call a mini Ratna category one CPSC. Basically, this status is given to those CPSCs which have made profit in the last 3 years before they receive this status. So, if we look into the metrics, we can see the revenue has been increasing. So, this company again it got listed in 2018. So so we can see that there's like a consistent growth in the revenue, and the company what they say is they expect this to continue because right now they have an order book of like 55,000 crores, and they say that they have enough orders to sustain this growth and maintain their CAGR, which is of 27%, which is visibly a 5-year CAGR. And next was gross margin, but sorry, one more thing I'd like to mention is majority of their orders also do come from the Ministry of the Railways, and the rest, a few, uh, they do through bidding. And yeah, the gross margin I wasn't able to calculate since the COGS was not available. And then we go to the EBITDA, so we can see the sorry, one second. Yeah. So we can see the EBITDA has also been increasing, and the EBITDA margin too has been increasing. So we can derive that the since EBITDA is the operating cash, so we can say that the operating expense is basically decreasing for their company. And PAT has also been increasing. All these measures you can see there's a consistent growth in it, and PAT percent, that is our net profit margin, that is also increasing, which is a good sign. Next, we move on to the balance sheet where we have debt. So one thing we must consider, since it is into construction, railway construction especially, it is a highly capital intensive industry. So they do need a lot of capital. That's why they have a high borrowing. They have higher borrowings. We can see which has continuously been increasing since 2017. And mostly what happens in these companies is that one source for like increasing their capital, the best source for them is debt. So like even you would see similar examples in like heavy manufacturing companies or and any airline company, I'd say. So basically they utilize a lot of debt and they use it as their most common way of financing. Next was debt equity ratio. Again, the same thing. It is a capital intensive industry, but considering that they do have a low debt equity ratio, which is it is a ideal value. I'd say it's not too high, 1.04 currently. And next we go to the FL ratio. Now FL ratio, if you see, it has been increasing, which is a little concerning, I'd say. So usually, I think a value less than one would be considered ideal. And other than that, like suppose you're 3.11, so it's kind of a risk. You can consider it a red flag. And uh, basically, higher ratio tells us that they're using more debt to finance their operations and assets and operations. And next we have the net fixed asset turnover ratio and the asset turnover ratio. So first, this net fixed asset, basically what we do is we divide net sales by their average balance of fixed assets. So it tells us how efficient a company at like generating sales from their assets that already exist. And basically higher ratio, as we see the ratio has been increasing, although here it was very high. I'm not sure why did it suddenly decrease so much, but uh, so after that, if you see, it has been growing back and it's come to 50. But yeah, again, that difference is very high, and I'm not sure exactly why it happened so. So if you consider from 18 to 22, then it has been increasing, which is a good sign because you can see that they're able to generate sales, making use of their assets more efficiently. Same thing with asset turnover ratio again. It basically tells us how they are at how efficiently they are using their assets. And so mostly now this depends from sector to sector. So what I read was in utility sector, since this would I think fall into utilities. So it should be from 0.25 to zero point 0.5 would be our ideal asset turnover ratio. Now ROE again, this is using the DuPont formula. So we can see net profit margin would be the highest contributor, but at the same time, net profit margin has been decreasing while FL ratio, if you see, has been increasing. So I mean, right now it is good, but a little concerning, I'd say. And then next is ROC, return on capital employed. So that I think the calculation was it's calculated for 2 quarters. Yeah. So I think half yearly, and then it basically tells us the profit they have made from their investments, the capital they have employed. So I think I'd say higher the better in both these cases. 15 a ratio 15 to 20% or higher would be ideal. So and next we have cash flow. Cash flow though obviously tells us the cash the company generates or they use it, consume it during that particular period. So in this case, we see there was for the longest time there was negative cash flow for like 3 years. So basically, we can say that there's more money that was going out than the money that was coming in. So they were using the money from the investments in financing to make up the difference, basically. And next one is free cash flow. That is basically the CFO cash flow that and we subtract it from the capex. So what it tells us is basically how much money that a company is left with from their revenue after they are done paying all their financial obligations. So sorry, yeah. So negative cash flow basically when again 3 years we had negative cash flow. So it tells us that the company does not have doesn't is kind of unable to,
Shantanu, would
yeah,
request you to speed up a little bit.
yeah, sorry, I feel so to generate like enough cash to support their business. Next would be CFO by EBITDA, etc. So if we see all these ratios again, so days of working capital I ignore for now, but it's 21 according to Screener, which is much lesser than what I've calculated here. So yeah, so all these ratios basically tell us the situation of their cash flow management. Next, we have the dividend payout ratio. So basically, the company is paying around 32% of their profits as dividends to their investors, and then we have the EBITDA to, I think, coverage ratio, interest coverage ratio, EBITDA to interest coverage ratio. So so it tells us if the company has enough interest coverage for paying their interest expenses. So 2.1 is good. And promoter holding is telling us that there's more, like you told me, one skill in the game. So 78%, and this is actually held by the President of India. So pledging nothing and care rating of AAA is good, that they are not defaulting, etc. And yeah, the rest is P ratio, PV ratio, all these ratios. If you see, since again I said 2019 where they listed, so you won't get the 5 year and 10 year median. But if you compare it, I'd say right now it is high because the median for the overall duration that it has been publicly listed, it was 6.2. And sorry, yeah, so PV ratio, ideally we prefer like it to be below one, but under three is also I'd say good. Ideally lower the better, and it's pretty close to their median, so not much of a difference. And then we have EV EBITDA ratio, which yeah, so it should be below 10 for if you're considering. It tells us the health of the company and what value it brings in. And then price to sales ratio, again, lower the better. So higher, what happens if the value of price to sales is higher? That it basically tells us they're using they're not able to efficiently use their investor funds to like get in revenue. Yeah, that's all.
Right. Thanks, Shantanu. That was quite detailed.
You're
So,
welcome.
you know, just one feedback to you. I think you were a little nervous today. So,
Yeah, yeah, long day.
yeah, yeah, yeah. So no worries. I think some of the definitions that you gave for some of the items, I know
Huh.
it's difficult to recall,
Huh.
but some of them were not exactly correct, and I we
Okay.
have discussed these before, and you know them. So
Yeah.
it's probably due to the pressure of presenting in front of people. So no
Hmm.
worries. That's just one feedback. So you can maybe try to take a few deep breaths before you start a presentation. This helps me, and I'm not
Yeah.
kidding actually, because otherwise my voice goes high and the heartbeat, bringing it down is always a good idea. And if you start practicing it from an early age, it'll help you. So
Yeah.
maybe one tip there. Gaurav, I'll start with just a couple of comments, and please chime in. So the first thing that I wanted to so one task for you is
Huh.
basically the financial leverage ratio. You said it'll be better if it's less than 1. Okay.
Yeah.
So you please read up on the financial leverage ratio, and then you reconclude what is a good financial leverage ratio. Okay.
Yeah.
So that is one. Then you said that gross margins could not be calculated. Okay,
Huh.
so I would urge you to go to their annual reports,
Okay.
and basically, the definition of gross margin.
Yeah.
So take the data from the annual report and try and see if you can calculate or not.
Sure.
Okay. Uh, and again, one more important question is, why isn't their PAT growing as fast as their EBITDA? So that is actually a question to which I also don't know the answer, because it's not a theoretical answer. Yeah. So
Yeah.
just do a deep dive and tell me, why the PAT growth is not as fast as the EBITDA growth.
Yes.
Okay. Yeah, that's it. And one correction, guys, my mistake in the sheet. So what I have called the EBITDA coverage ratio is actually the interest coverage ratio, as Shantanu correctly said. Yeah. So it is the ratio of EBITDA to the interest payable for that period. Okay, so it's called interest coverage ratio. And just to refresh all your memories, and Shantanu, a small correction, that this
Ah,
ratio should at least be 4
okay.
for the company to feel comfortable about servicing its debt. Okay,
Yeah.
so 2 is actually a pretty dangerous ratio.
Oh,
But because this company is owned by the government of India, so the risk is a little low,
hmm.
but still. And last thing, you said promoter skin in the game is good. 78% holding, that's a good thing. That is a good thing. If the promoter is the government of India,
Yeah.
then it is not exactly the same thing, right?
Okay.
I mean, it's a government-owned company at the end of the day. Yeah,
Yeah.
government will have skin in it. But sometimes what happens is, to raise money, government keeps selling its stake. Okay, so Gaurav can tell you more about this from IRCTC. So very high government holding sometimes can work as a negative for investors, because government will keep selling stake whenever it has to raise money. That will bring the stock price down. So just be careful. When the promoter is GOI, then things are a little different. Okay.
Okay.
Yeah. Thank you, Gaurav, please.
Thank you.
So I have no feedback. I actually enjoyed the presentation, and I think we should do it more. I mean, this kind of sessions, because you get to learn so much. It's an interesting company, although I feel it's overvalued. But no feedback for you, Shantanu, right now. One thing that you could do is, when you are going through these, say, CFO upon operations and all. If you are, say, for example, I'm not a non-financial guy, so many times when I hear these things, I generally try to think it how much cash flow they're generating out of the money that they are selling, something like that, CFO
Ah,
upon, say, EBITDA or something like that. Yeah. So some common words which kind of, which is easy to understand. So you could also
yeah.
take that approach. Yeah. I mean,
Sure.
and then go forward with it. But
Yes.
that depends on the audience actually. I mean, for me that a dumbed down version actually works a bit more better. But yeah. But overall, I liked it. Thank you.
Thank you.
Great.
Thank you, Shantanu.
Yeah.
So Gaurav, should we have Bhavna's session also tomorrow? We'll overshoot the time a little bit, I think. I mean, today can we have it?
Yeah, let's have it. I don't
Okay,
have any problem.
great, great. Bhavna, go ahead, please.
Yeah, one second.
So this is a company that I don't know, Bajaj Electricals. Gaurav, do you know?
Nope.
I mean,
And
I have
get that.
never studied it, so I'm
Yeah.
looking forward to the presentation.
Yeah, exactly. So the one that Pranav was explaining, I knew a bit of it, so it was interesting. But Shantanu's one was completely not known by me, so
Yeah,
it was interesting for me.
right.
Is my screen visible?
Yes.
Okay, so I'm going to present on Bajaj Electricals Limited. It's an Indian consumer electrical equipment manufacturing company based in Mumbai. So basically, its business portfolio spans consumer products, lighting, and EPC. So starting with the P&L, revenue for Bajaj Electricals has increased from 4,254 crores to 4,768 crores. It saw a sharp fall in financial year 2020, which could be because of the COVID-19 pandemic, which reduced demand for electronics. The gross margin percent, which shows how the production cost affects the revenue, is fluctuating between 2017 and 2022. 2022 within a narrow band of 23% to 37%. It is somewhat predictable, but it is lower than some of its competitors like Bharat Electronics, which has 43.58%. But it is in par with some of its other peers like ABB Cables, which has a margin of 37.87. The EBITDA and the EBITDA margin for 2022 have fallen, which could be because of inability to raise prices, rising costs, or high competition. The PAT uh, the PAT percentage has fallen to 3.2% in financial year 2022, uh, probably due to high costs or they were not able to manage their costs properly. Um, and then going on to the balance sheet. The debt equity ratio it has been falling from 0.78 to 0.34, which shows that Bajaj is using lesser and lesser debt financing for expansion purposes. So it has lower risk. So it shows that Bajaj Electricals has 0.04 rupees of debt for every 1 rupee of equity. Going on to the financial leverage ratio, it shows how much capital is acquired through equity. It has been falling for nearly 3 years. It could be due to reduced use of debt financing. The fixed asset turnover and the asset turnover ratio show fall from 2019, but it has been picking up slowly. The sudden fall could be because of new infrastructure or machinery purchased, but they have not yet started contributing to revenue. The asset turnover ratio seems to be consistent. It is ranging between 1 and 2. Um, Going on to the ROE, it has been falling, which shows decreasing efficiency in generating income and growth from equity financing. It I From the DuPont formula, I think it could be because of falling financial leverage ratio. And then going on to the cash flow, uh, the cash flow from operations, um, it has been increasing in financial year 2020. It now stands at 936 crores. The days of working capital, it shows the number of how fast it is able to convert working capital to revenue. It has been falling, which is a good sign. So probably sales are increasing, and Bajaj is able to collect its receivables faster. Mm, And going on to the other ratios, the dividend payout ratio in 2022, it showed 22.45%. So, 22.45% of the earnings are paid out to the shareholders out of the profits. So, but it is actually lower compared to some other companies like Orient and Voltas, which have nearly 35%. The interest coverage ratio stands at 4.29%. So, it can nearly pay 4.29 times the interest it has to pay today. It is not a very great situation, so it might be hard for Bajaj to get more debt in the future as it will increase its debt burden. The valuation ratios for all three ratios like price to equity and price to book, and the EV by EBITDA ratio, they all show slight overvaluation because it is of all three ratios it is higher than the median. Um, so it might not be a very good sign for investors
Sorry,
as the price.
Bhavna, am I just to interrupt? Am I seeing something wrong, or is it lower than the median for the first two items?
Uh,
It's 59.4 is the median, and current is
oh no.
26.
Oh yeah, this one. It's a fire median. Actually, I was telling from some notes I took down from screener.
Okay. So, yeah, this is one question in general I have for all of you guys. Why are you guys having to refer to a screener, while you're presenting the Excel sheet? This, I think Pranav was also doing, so I was not clear on this. But anyway, finish it, then we'll discuss.
Yeah. So for the price to equity ratio, the median. Oh, Uh, Actually, I'm sorry. I think the median is correct. I think I entered some numbers wrong here.
Okay, okay, no worries.
So It's actually the current price is 60 and the median is 59.4. So it is slightly overvalued. Similarly, for the price to book ratio, it is currently 7.2. No, it is currently 6 point. Can I please check these values and get back? I think while typing in some numbers, I mixed up the median and the current values.
Yeah, yeah, no worries. Any other comments before you finish?
Uh, no, that's it. I'm done.
Okay, great. Gaurav, you want to start?
No, not quite. I mean, I don't have
Okay.
many questions.
Okay, okay. So, good presentation, Bhavna. I have a few questions. Just make a note of these. I want you to get back to us with, answers to these. Okay.
Yes.
So, uh, the first is, right now, can you tell me what is EPC? You said that the company is into EPC. Do you know what EPC is?
I didn't go deep into it, but it's something relate. It's related to energy.
Okay, so the first task for you is understand what EPC is, okay? And you
Yes.
said that BEL, Bharat Electronics, you compared some metrics of this company with Bharat Electronics, right?
Yes.
Yeah. So is it the right comparison? That is the second question. So first question is what is EPC? Second question is BEL the right comparison? If not, what company should you be benchmarking Bajaj Electricals with?
Yes.
Okay, that's clear.
Yeah.
Okay. So the next one is the cash flow from operations in the last 2 years has suddenly, like, or the last 3 years, has suddenly jumped, right? It was
Yes.
negative earlier. So, what changed in the business? That's the next question that we want you to dive into.
Okay.
Okay. Why has this happened? And yeah, so go up to the profit and loss part. Yeah. So, any comment on the EBITDA and PAT CAGRs, or even the revenue CAGRs? Like, what do you sense is happening in this company?
Uh,
Just look at the revenues over 5 years. Look at the profits. Look at the EBITDAs. What is the sense that you're getting?
I thought that it had been increasing, but then after COVID-19 struck, it then fell and it's slowly recovering.
But is the recovery happening actually? And you said FY20 was COVID-19. FY20 only 1 month was COVID-19, right? So the jump from 6656 revenue in FY19 to 4975 in FY20, is it really due to COVID? There was only 1 month of COVID in FY20, March, right?
Yeah.
Yeah. So the last question for you is what is happening to the company's revenues, profits, EBITDA? Why is everything going down?
Yes.
Yeah. Good presentation, Bhavna. Especially, I liked your comment on, you made a comment on the net fixed asset turnover. In terms of, I think the net fixed asset turnover was decreasing. So you made the right comment saying that it is using up more resources to generate the same revenue. So that means you understand this ratio well. So good job, and keep it up.
Thank you.
Okay, Gaurav, comments?
Yeah, overall, I really went through this one. It's good. I was actually going in screener and looking at it as well.
Yeah, same here. Same here.
It's an interesting business, but I think I mean, what I don't understand is why are they paying so much of their debt at this point? This is,
Right.
I mean, from a business point of view, it doesn't make sense to go down to such low level. Maybe it's because
Yeah.
their products are not selling. I mean, there's too much of competition in the white goods
Gaurav,
segment.
let's wait for
Yeah.
Bhavna to come back with the answers. Yeah.
Okay. Sorry. Yeah.
Yeah, yeah. But one general question that I think, Gaurav, I would like all of you to take down, apart from the company specific questions that I want to that we want you to come back with, take down this question. All of you have made this comment that this company seems overvalued, company seems undervalued. Okay. and you've made that comment basis this 5-year median and things like that, right? That 5-year median से नीचे हुआ तो it is undervalued, 5-year median से ऊपर हुआ तो it's overvalued. I heard multiple people making this comment. So the question that you need to answer is, how do you decide overvaluation or undervaluation? It's a general question. Okay. So that this all four of you have to answer in addition to the company specific questions we discussed. Yeah. Right. So, all four of you guys, please drop the questions that we discussed for each of your companies on the WhatsApp community that we have, and let's meet up again sometime. I'll let you know after discussing with Gaurav, and then we'll go through your answers to those questions. Yeah.
Yes.
Yes.
Yeah, but just finishing comments, final comments from my side. Really pleased with the effort and the kind of discussion on the metrics that you guys have done, because I realize all this is very new for you guys. So to absorb it, to comment intelligently on these so many ratios, right? Sometimes I also get confused. So most of you have 70% of the ratios and the numbers that you were commenting on, they were actually the right comments. It means that you understand that ratio. So it's very, very encouraging, and it's really great to see that all of you are actually spending time in learning. You'll learn very fast, trust me. So very good job on this, all four of you.
Yeah, same feedback from me as well. It was very interesting, especially Bhavna, yours, and also Shantanu, yours. Pranav, I know your topic, but I really liked the way you got deeper into the topics. One thing you can improve on is your pacing or your timing of the presentation, but other than that, very diverse. And Radhe, your presentation was top notch, especially from the storytelling point of view. So all of you can learn from each other, right? And set up a benchmark from the next time we meet, because I would like to have such sessions more, because yeah,
Absolutely,
it's
because
a great way
Gaurav,
to
I
learn.
would like to learn from them about companies that they are analyzing, right?
Correct, correct.
So yeah, so I think the day is not far, guys, when you guys can come and present a company to us, and we learn about the company from you. I
Yeah.
think you all are moving in the right direction. And राधे, आईटीसी से इतना मतलब आईटीसी कैसे चूज किया आपने? आपका आपका स्टोरी काफी अच्छा था, तो कंपनी को आप काफी कुछ टाइम से ट्रैक कर रहे हो या मतलब क्या?
Yeah, when I started investing in stock market, I started with ITC
अच्छा, कब से कर
Ah,
रहे हो तुम इन्वेस्ट मार्केट में?
since 11th standard.
That is how many years ago?
4.
4 years. Okay, very interesting. It showed, मतलब पता चल रहा था हमें कि तुम स्टॉक को जानते हो. So good job on that.
Yeah.
अब ज़्यादा मज़ा तब आएगा ना जब तुम नया बिजनेस पढ़ोगे और उसको प्रेजेंट करोगे, क्योंकि तुम्हारे लिए भी इट विल बी अ न्यू डिस्कवरी ऑफ अ स्टोरी, राइट?
Yeah.
अभी probably you knew part of the story. When you analyze a new company, it will be like, and then जब जो मज़ा आता है ना, when you solve कि अच्छा इसका ROE क्यों ऐसा है, that's a entirely different feeling. So yeah, you will also get that feeling soon.
Yeah.
Great. Okay.
Thank you.
Thank you so much, guys. A good
Thank
job. Very
you.
good job.
thank
Thank
you.
you.
Great job.
Yeah, great job. Bye bye.
Bye
Take
bye.
care.
Bye.
Bye, Gaurav.
Bye bye.
Bye.